Most people believe a bank is a giant vault where you store your hard-earned money. And in return, the bank lends that money to your neighbor for a mortgage, keeping a tiny slice of interest for itself. It is a clean, simple, reassuring story, and it is completely wrong. If that was how banks actually worked, the entire U.S. financial system would collapse in less than 24 hours. The truth is much stranger and far more lucrative. American banks do not store your cash in a safe, and they do not wait for your savings to lend money. They run an invisible, digital toll booth network that charges a tax on almost every single dollar moving through the economy. And when they do make loans, they literally create brand new currency out of thin air with a few keystrokes. So, how does this hidden money machine really operate behind closed doors? Where does the real profit come from? And why is the system built to make sure competitors can almost never enter the market? To understand the real business model, you have to look at what happens when you buy something as simple as a $5 cup of coffee. When you tap your plastic debit card at the local cafe counter, you assume your bank simply tells the store's bank to move $5. It feels instant, seamless, and free, but behind that 3-second delay on the screen, an unseen chain of financial intermediaries jumps into action. Your bank, the payment network, and the merchant's bank perform a rapid digital negotiation. And before the cafe owner sees a single penny, the banking system quietly slices off a small percentage fee. This is called the interchange fee, a hidden toll levied on millions of transactions every single second of every day. You never see this charge listed on your receipt, but the business owner pays it, and naturally bakes it right into the price of your coffee. Multiply that tiny transaction fee by billions of daily swipes across America, and you begin to see the foundation of an unstoppable revenue stream. It is a business where customers pay for infrastructure without ever realizing they are paying for it. Yet, transaction tolls are only the outermost layer of this financial engine. The real magic happens when you hand a bank your actual savings. Imagine walking into a branch and depositing $10,000 into a standard savings account. You might look at your mobile app, see $10,000 in your balance, and feel confident your wealth is sitting securely in a vault. In reality, the bank does not hold your cash in reserve. The moment that money hits your account, it transforms on the bank's balance sheet from an asset into a legal liability. To the bank, your deposit is a loan you gave to them, and they owe you interest on it. So, how does a bank turn a liability into immense wealth under modern banking rules? The bank takes your $10,000, sets aside almost nothing in reserve, and uses it to back entirely new financial assets. When someone walks into the bank 10 minutes later asking for a $200,000 home loan, the bank does not collect cash from other savings accounts to hand to that borrower. Instead, the bank types numbers into a computer screen, creating a brand new deposit balance for the homebuyer out of thin air. Through this mechanism, known as fractional reserve and credit creation, banks literally generate fresh money into existence. They charge 5, 6, or 7% interest on money they just manufactured, while paying you less than 1% on the deposit that made it legally possible. This gap between what banks pay you for your cash and what they charge borrowers for theirs is called the net interest margin. It is the core profit engine of commercial banking, a massive, passive spread generated on trillions of dollars across the country. Consider a real-world case study, a major national bank holding over $1 trillion in customer deposits. If that bank manages to widen its interest spread by just 0.5%, it generates billions of dollars in pure extra profit without adding a single new customer or opening a single new branch. It is an economic model where scale creates near-infinite leverage. This raises an obvious question. If creating money and charging tolls is so insanely profitable, why doesn't a wealthy entrepreneur start a brand new bank tomorrow and undercut the legacy giants? Because the legacy banking system is protected by one of the strongest defensive moats ever constructed in corporate history: regulatory capture and infrastructure control. To operate a real bank in the United States, you need a formal banking charter granted by federal regulators. Securing that charter requires hundreds of millions of dollars in capital, years of legal negotiations, and approval from institutions that are deeply intertwined with existing megabanks. Even if a modern tech startup builds a gorgeous app with zero fees, it cannot hold deposits or access the Federal Reserve's central payment wire directly without renting access from a traditional chartered bank. Silicon Valley tech companies quickly discovered they could not disrupt Wall Street. They had to become paying tenants of Wall Street. Legacy banks essentially rent out their regulatory licenses to tech startups, taking a cut of the startup's revenue while shifting all consumer acquisition costs onto the newcomer. It is a system designed to ensure that no matter who wins the consumer tech battle, the underlying banking cartel gets paid. Yet, every high-leverage business model carries a silent, lethal risk. The entire banking system rests on a single psychological foundation: trust and liquidity timing. Banks borrow short-term money from you, since you can withdraw your cash instantly, and they lend it out long-term into 30-year mortgages and long-dated government bonds. This is called duration mismatch. As long as everyone behaves normally, the money machine works perfectly. But if depositors suddenly panic and demand all their cash at once, the illusion cracks open. The bank does not have the physical cash in the branch, because that cash was transformed into 30-year debt instruments hours after it was deposited. When panic spreads digitally in the modern era, billions of dollars can leave a bank via mobile apps in a matter of minutes, causing a catastrophic bank run before regulators even wake up on a Monday morning. So, how do megabanks survive a flaw that could destroy almost any other private corporation? They have a unique partner that no other industry possesses: a central bank acting as the lender of last resort. When a crisis strikes, the Federal Reserve opens emergency lending facilities, allowing commercial banks to pledge their long-term, illiquid assets in exchange for immediate cash. This backstop removes traditional bankruptcy risk for the largest institutions. If a normal business makes bad investments, it goes bankrupt and closes its doors. If a systemically important bank makes bad investments, it receives emergency liquidity facilities to bridge the gap until markets recover. This dynamic creates what economists call moral hazard, a scenario where banks keep all the massive profits during boom times, while the underlying risk of systemic failure is quietly backstopped by the entire economic system. This brings us to the hidden truth powering modern finance. Banks are not simple storage vaults, and they are not ordinary private companies competing in a free market. They are private franchises operating a public utility. They own the rights to create digital currency, to tax every transaction in the nation, and to use public backstops as their safety net. When you look at a bank branch on a street corner, you are not looking at a place where money sits quietly waiting for its owner. You are looking at a regional node of a massive, sovereign economic engine, one that turns human activity, credit, and digital confidence into silent, continuous profits. Understanding this dynamic fundamentally changes how you view money itself. Your balance in a bank app is not a stack of dollar bills held in a vault for safekeeping. It is a digital receipt for an unsecured loan you made to a private institution. And, in the modern economy, the institutions that control the movement and creation of those receipts ultimately control the financial rules of the world.